Scott, I saw something in the notes. I'll just start with you quickly. You say, sometimes things aren't that complicated. Low interest rates are pretty good for stocks, are they not?
Low interest rates are great for stocks. High earnings, better earnings are great for stocks. And we had a really good earnings season. We had a nice quarter. Most people expected an earnings recession. We had a little bit of earnings growth. And, Joe, over time, that's about 90% of the equation.
I guess if someone were to point at a problem with your thesis, they'd say, well, earnings aren't growing. There's an earnings recession because we had a couple of great years, and now the comps are so hard to match.
Well, I mean, we actually had a little bit of earnings growth, not very much, but we had a little bit. The quarter ended up better than expected. The problem right now is the other 10% of the equation. It's whether it's trade or what's going on in Hong Kong or Dorian. I mean, all of that over time may wash out, but you have to get through the week. Well,
there's people, Scott, and you know who they are, that look at 2020 and they have three scenarios. There's one guy in particular. One where the S&P is $185, one where the S&P is kind of flat at $165 of earnings, and one where you actually see a 10 or 15% drop to the 140s. And that could totally change where, you put the same multiple on those three numbers and you have a wide range of where the stocks could be at the end of, the S&P could be by the end of next year.
And the problem is, how much lower can rates go? We don't want to see rates that much lower because that really means that there's a problem, frankly, particularly in Europe. I mean, they're about ready to implement more easing, and that's only because things aren't going particularly well over there.
All right, Gene, you say nobody likes what's happening, but we just keep moving along. And you think the trade problems get settled more quickly than people think, and the Fed does continue to ease. Is that your view?
Yeah, I think so. So when we talk about stocks, obviously interest rates and earnings are definitely very important. What we do, though, is what's more important is the U.S. economy. We've termed the U.S. economy a cockroach economy because it won't die. Everyone hates this economy. No one believes in it. But in our opinion, it's going to muddle along for a long time. So you think about who hates it. You have bond investors. They're really pushing yields lower. They're inverting the yield curve. You look at equity investors throwing volatility much higher. Even commodity investors are throwing, doing an economically insensitive trade by buying gold and selling copper. Even the Fed, think about the Fed. They sprayed raid on this cockroach economy 9 times in the last 3 or 4 years. Now the Fed doesn't believe it's going to last, and they're going to cut rates next month. We're worried about the fact that the Fed funds is actually trading higher than the 30-year Treasury. That's something that suggests that the market wants more rate cuts than the Fed is really talking about, especially last week.
So you're kind of making the case that when things aren't that loved, that maybe they continue to when they get too beloved, then you're getting ready to top out, and we're not there yet.
Yeah, and remember, Joe, when you and I have talked last time, we talked about being cautiously optimistic. While we love the fact that we're in the longest expansion ever, longest bull market ever, one thing we're watching is valuations are pricing in perfection, pricing in a super dovish Fed, pricing a trade war resolution, which we do believe will be resolved. But unfortunately, valuations are pricing it. So we're not bearish, we're just cautious, and we're telling our advisors and their clients to really look to, take some profits, reduce a little risk. Part of it is rebalancing back to long-term investment objectives. Think about this. A 60-40 investor coming out of the Great Recession today, without rebalancing, is about 83% stocks, 17% bonds. By doing nothing, you've actually increased your risk in your portfolio. You look at equity risk. We're suggesting reduce equity exposure by diversifying, looking at value. Everyone loves growth stocks, but growth is up above value by 10% this year. And then within fixed income is your safety part of a portfolio. Okay. But as yields have been so low for a long time, everyone's been jumping in high yields.
What's interesting, Gene, is that a lot of the things that you cited in terms of where we have negative yields, the rotation from industrial metals to gold, all those things point to a slowing global economy. And so, Jim, I wanted to bring you into the conversation. I mean, at some point, doesn't the U.S. economy get hit by a slowing global economy? And with tariffs due to go into effect at midnight on Sunday, shouldn't corporate profit numbers be adjusted accordingly, at least for this third quarter?
Well, I think they have already. Of course, we've gone from basically 3% growth a year ago or so to about 2% right now. And when you look at the details, exports have clearly weakened. We've been seeing flat to even slightly negative export numbers, and along with that, the manufacturing sector has been weaker. But the overall economy, while it slowed, has obviously not collapsed. And I think that's where we are. Now, going forward, I mean, we keep getting days like last Friday, of course, and if there's enough of a hit to confidence broadly and equity markets, then that could drag us down a lot lower. But, I mean, as of now, if the trade tensions remain a bit of a drag, global growth remains weaker, but it hasn't completely collapsed, then I think we could continue to get more of the same of 2% type growth, which would be consistent, I guess, with what Gene is saying there. But for sure, there are vulnerabilities here with the trade tensions and with the global numbers still being on the weak side.
Yeah. Scott, how do you assess how we enter the month of September?
Well, unfortunately, we know that volatility is, we call it lumpy. That is, the market gets volatile and it stays volatile for a while. We're certainly going to have to put up with that. I think that we do have some good news on the trade front. The spokesman for the Chinese Foreign Ministry today said some things that sounded conciliatory, that they're going to continue to talk. Right now, that's all the market wants, is them to continue to talk.